Okay, in this video, I'm going to revise again chapter 1, which is a topic of depreciation and disposal. Alright, so basically we do the depreciation and disposal for fixed asset or non-current asset. So this is actually the flow, how the asset being purchased until it being disposed. Okay, the first part here, if you see, this is a process where the company purchase a new machine. Okay, they purchase a new machine, so we have to record this purchase. It will be debit fixed asset, credit bank if you use check to pay for the fixed asset, or if there is a credit basis, you buy from someone on credit, so you have to credit creditor's name. Okay. So debit fixed asset means asset increase, credit bank means bank decrease, credit creditor means creditor or liability increase. Okay, so that's why we have this double entry. Then we use the machine to produce the product. Okay, so you see, right, because when we produce a product, it generate revenue. So this the usage of this machine must be matched with their expenses, which is we call it as depreciation. Okay, depreciation is the allocation of cost for the machine, or it can be the expenses of using up the machine, and it will be calculated each year. So it's related to matching concept to match the revenue and expenses during the related period. So the double entry to record the depreciation will be debit depreciation expenses. Yeah, depreciation is part of expenses, that's why it's debit. Increase expenses, and credit accumulated depreciation. Accumulated depreciation is the accounts to accumulate, okay, the depreciation every year. Okay, then let's say you use up the machine for 5 years, 10 years, okay, so maybe the machine are not so productive, or maybe you want to buy a new machine, so you're going to sell off the machine, so selling the machine to the other person, so this is called disposal. Okay, so there's a step in preparing the double entry for disposal. We're going to see that one later. So but at the end, we're going to see whether the selling of the machine give you a profit or loss on disposal. So this is our last thing we're going to find lah from the machine, and the machine is no more already in your business. So we go back to the depreciation method. So basically we have in our syllabus we have two method, which is a straight line method based on costs. Okay, so there's two ways to calculate this depreciation using this method. Depreciable amount divided by estimated useful life. Depreciable amounts means cost minus scrap value. Only the amount that can be depreciated. That's the meaning of depreciable amount. Okay, divide by estimated useful life. Maybe a estimate to use for 5 years, 10 years. Okay, or it can be also percentage given. 10%, 5% times the depreciable amount, so which is the cost less scrap value if any. If no, we use cost. Right? So the second method is reducing balance method, which is based on net book value. So the calculation will be percentage, how many percent given, so 20%, 10%, 50% times net book value. So what is this net book value? Net book value is cost minus accumulated depreciation. Right? Okay, so this is two depreciation method. Now we go back to the disposal entry just now. So basically there's 4 steps involved. Okay, step 1, okay, close fixed asset accounts. So how to close fixed asset accounts? Debit disposal, credit fixed asset. Okay, it's actually to remove the asset from that asset accounts. Step 2, close accumulated depreciation accounts. Same goes here, to remove the accumulated depreciation that accumulate every year. Okay, debit accumulated depreciation, credit disposal. Step 3, record the sales proceed. What you get from your sales, from your disposal. You get money in terms of bank, okay, you debit bank, credit disposal, or sometimes you trade in your old asset being disposed by trade-in, you still have value, so that value will be debit fixed asset, credit disposal. Okay, trade-in amount will be used up to compensate with your new machine, new asset value. Okay, let's say the new asset is 10,000, then you trade in your old asset, the value is, let's say, 4,000. So 4,000 is the value of the sales proceed, and you only have to pay the 6,000, okay, to get the new asset. Right, and then step 4, close disposal accounts. Just now you see there's a disposal accounts created here and here. So last step is we're going to close our disposal accounts and calculate profit or loss on the disposal. So if there is a profit, the amount will be the amount of the remaining amount will be in the debit side. So we debit disposal, credit income statement. If there is a loss, the amount remaining will be at the credit side. Okay, so we debit income statement, credit disposal.